of the firm, director of investments. Figuratively alongside me is Kate Freeze. For those of you who haven't participated in one of our calls, what I generally do is start with some prepared remarks and then open the floor for the fun part where you get to ask questions and we just hear what's on each other's mind. We really love that part the best. I just wanted to start with really just best wishes for everyone's health and safety. We've been very relieved here that today we haven't heard from any client that they or a close family member has been stricken with COVID-19. What a relief that's been. We'd also like to share with everyone that all family firm staff members have been, to the extent possible, extremely responsible, and that no one on staff has had any COVID-related health issues during this crisis. We've successfully transitioned to remote working. It's gone very smoothly. Kate's been in charge of our disaster procedures, and we all feel we were as prepared for a crisis like this as well as anyone could have been. So it's been quite a 6 months. The economic depression induced by COVID and the lockdowns have been followed by a fairly robust economic recovery, although we're still far from the pre-pandemic levels. The stock market, on the other hand, has had a complete V-shaped recovery, and by some measures, it's at all-time highs. This despite ongoing high levels of cases and deaths and an unemployment rate in the 10% vicinity. As to why, I did mention way back in March that the federal government was on the case, fully committed, and those initial responses were powerful, targeted, and effective. The safety net measures passed by Congress helped cushion the economic fall, but for investors, the more important rescue is coming from the Federal Reserve. In addition to cutting the interest rates back to zero, there have been numerous other loan programs and the like that have put a floor under lending costs, and that's translated into support for profits and stock prices as well. What a contrast from 1929 and 1930, where the conventional wisdom was to stand back and let the market do its thing. And the market doing its thing ended with runs on banks and 25% unemployment and a 10-year slump. So this success is, it's been great, certainly from the investor standpoint. But as always, we want to be thinking about tomorrow and the months and years to come. And as I do think about that, I begin to contemplate what comes next, with the full realization and sincerity that no one really knows what comes next. But I do have some experiences and just senses about how things can unfold or develop in the markets. And one thing I've certainly come to know very well is that initial success breeds confidence. The actions taken by the government successful breeds confidence. Further success can be quickly followed by overconfidence if unchecked. And that can eventually lead to complacency. And actually, that's kind of what I'm consistently struck by these days. The complacency that's completely prevalent right now, and is, in my opinion, collectively forms the biggest risk to the financial state and our own investments. And that word complacency, I hope you'll indulge me, is just one I'll continually cite and come back to. And I have several examples of this. Just for a first one, it's not really related to the investing world per se, but recall that I started off with appreciation for the mature and cautious way our clients and staff have behaved during the COVID era. And contrast that to what we've seen in parts of the US and now in Europe too. Measures were implemented, success was achieved, and all too soon, complacency set in, overconfidence developed, and reemergences all over the place. So that's that, but how about on the world of economics and investing? Well, where should we start in that realm? So I just have a few areas to discuss on that. Inflation being one. So there's no doubt that the war against inflation that began in 1980 has been won pretty decisively, not only from the central bank vigilance, but also from numerous factors such as expansion of trade, the breaking of union power, and the labor efficiencies brought about by better and smarter machines. But does this mean we disregard inflation going forward? Have the successes achieved caused us to become overconfident? Well, based on the interest rates available today, one would be justified in saying yes. When 10-year treasury yields are well below 1%, it's clear the sense of investors is fully confident that inflation will not reemerge. Perhaps, but what if that's wrong? Another area, how about the debt, government and private debt? The government's level of debt is or will be at an all-time high by any measure. And yet again, success has bred confidence. The unprecedented borrowing by the US and foreign governments has received nothing but yawns from investors. Interest rates have remained historically low, and for the most part, the investing public has cheered on ever larger piles of debt. Are they overconfident that debt will never threaten the US or other major economies? Well, history tells different and frightening stories about the perils of excessive debt and unfunded commitments. Let's hope that history doesn't repeat itself. And moving on to another area, what about the election? It seems to me the markets are very dismissive of the election and its potential impact. It seems there's a huge degree of confidence that no matter the actual outcome, things won't fundamentally change. That's to be determined, but perhaps this consensus will be shown to be wrong. And even within the market itself, thinking about the election, there are huge contradictions. You've got alternative energy stocks surging as if the Green New Deal was starting to be adopted. But then in other parts of the market, the stock prices are behaving as if there'll be no changes in regulation or taxes. So can they really both be right? And this isn't the only place where investors are contradicting themselves. We have the price of gold and other tangible assets soaring while interest rates are still so low. That's a contradiction that doesn't really make sense. So I could go on and on with my examples. I do apologize for, honestly, the shallow description of some of these points, but it would be remiss if I didn't mention the scariest manifestation of complacency and overconfidence, and that's in the stock market, or at least in certain parts of the market that have been overcome with exuberance and have entered the dreaded bubble phase. For those of you who have been with the family firm for many years and have known me throughout that time, they might recall I've always shied away from the B word. But I honestly just can't think of any other way to describe what we're seeing today in certain areas of the market. What's perhaps most remarkable and scary is that it seems at times that no one is watching. You know, the Fed has been lauded for its recent actions, including that they're willing to let inflation run high. Yet almost incredibly, they show no concern over speculative activity in the markets that we haven't seen for more than 20 years. And just today, I saw a governor comment that there was nothing to be concerned about given what's going on in the world. I would humbly disagree with that. But you know, these promises of free money and unlimited financial backing has really encouraged the return of the day trading era and resulted in some enormous distortions that can cause unsuspecting investors anguish down the road. And I think one could find many examples of this exuberance, and mentioning them wouldn't constitute a buy or sell recommendation on any particular stock or market. But let me just cite a few of them. And first, just as to the general level of the stock market, a really obvious and clear way to assess this level of a market is to compare it to the gross domestic product of the economy. By that simple measure, the American stock market is as high as it's been since 1999. And that was not a good time for investors, what was about to happen. So that's kind of where we are today in that measure. There are even some more perhaps descriptive ways of thinking about it when you think about things on a company basis. So take Apple, for example, a great company for sure, has now, thanks in significant measure to investor enthusiasm about the future, become worth more than the entire German stock market. So Apple's price to earnings ratio is as high as it was back when it was experiencing explosive growth and pioneering new markets. It's just very hard to see how that level of enthusiasm is justified for a company working in mature markets with plenty of competition. Okay, and just one more company example, Tesla, perhaps one day will be a great company. Now, if you look at its market value, it's nearly $1.25 million for each car they've sold. That's the market value of the company. So that's quite a profit margin, I would hazard a guess. So how can some of these things really be called anything but a bubble? Now, of course, none of this means that things will reverse in short order or even at all, just to be honest. As we've seen, as we've seen, success beats success, beats success until it stops, and it doesn't anymore. That seems to be a truism that's really always happened with markets. So, as for what to do with our investing strategy and approaches today, well, I will promise you that the family firm will do our best to steer clear and at the very least underemphasize those areas of the markets that in our considered judgment have become the most complacent and detached from the world of risks and uncertainty. So whether it's overpriced bonds or runaway sectors of the stock market, we'll do our best to strike the balance between what we see in the market and also to do our best to avoid overconfidence in our own ability to predict the future. No one can do it, and we can never become overconfident in our own ability to think we know what's going to happen. But that's the balancing act we'll try to achieve, with the recognition that it's quite likely that following that approach, results will differ in some cases from benchmarks, especially when the equity benchmarks become more and more reliant on 5 or 6 technology stocks. So with that, we would love to hear your thoughts and questions. And if she doesn't mind, Kate can just explain how we'd like to approach that. Thanks.
Hi, everyone. Just wanted to let you know that if you'd like to ask a question, please unmute yourself. If you're on screen, that means you can click in the lower left-hand corner of your screen and turn on or off your microphone. And if you're on the phone, you will press *6 to unmute yourself. And then we just ask that you remute yourself when you're done, or I can go ahead and I'll click it if it sounds like the question's finished. I won't cut you off, I promise, but just so that we can try to get a clean audio for everyone. So anyone who would like to ask a question, please go ahead and unmute yourself. We may need to take a few, I'll name out some folks if we have a few at a time trying all at once.
Hi, Nate. I have 2 questions. One is, within this overvalued technology phenomenon, are there any technology companies that or subsectors that you think may continue to do well? I mean, I was thinking this morning, for example, if every school district in the country had to purchase thousands of Apple computers, I mean, that could explain some of the enthusiasm around Apple. I can't see Tesla, for example. I agree with you on that. Mm-hmm. And then the second question would be, with so many sectors perhaps overpriced, what do you see in the next 5 or 10 years that is now not overpriced that you might consider investing in?
Yeah, thanks. And I guess a lot of school districts have been buying computers, but honestly, it seems like they've been concentrating more on the things like Chrome and things like that you can buy for $100 as opposed to an iMac. But certainly you're right. And actually, with Apple, some of the justifications I've seen is that, well, once the 12 comes out, that's going to completely revolutionize everything. I mean, maybe it's possible, but Samsung has their version of it too. And again, we're still talking about incremental growth, not a doubling or tripling of profits in 5 years as the market is kind of anticipating. As far as other areas of the technology market, they're a little hard to find. I would be honest about it. I would say probably some of the more tried and true companies, I guess, or the companies that receive a lot of their revenues from recurring sales and things like that, they're set up to do well. It's just a matter of how much do we pay for those earnings. And, going forward, if many of them will be allowed to continue to function as a quasi-monopolies they are today, or monopolies today. Certainly monopolies deserve a high valuation, they've got one. It's just a question of, well, what happens either in terms of competition or regulation if that starts to change a little. And as far as, inexpensive markets, I don't know, because they have to eventually turn around their economies too. But if you look at Europe's or something as opposed to the US, it's never been less expensive, European stock. But the economy is not exactly dynamic. So it's sort of a trade-off. But certainly if you're just looking strictly on a value level, you would say, oh, banks, energy companies, and European companies in general, kind of the non-technology areas of the world, are not as giddily priced as California is right now. Thanks.
Nate, this is Alfonso. How are you?
I am great. How are you?
I'm fine. Nate, I have a question. Listening to you, is this going to affect in any way the share of cash that you should keep in your portfolio?
My opinion, yes. So I almost kind of think of it as normally within the allocation to bonds or things that aren't stocks, that some of the bonds that comprise the bond index, a lot of the long-term, type loans to governments or companies are just so expensive, which is another way of saying interest rates are so low, that it makes sense, in our opinion, to have some money off the table, there's some money not at risk. Maybe it's not earning that 0.5% to 1% that some of the bonds can do, but while avoiding the downside risk, just in case that some of these scenarios that I said were possible, certainly the inflation coming up, interest rates coming up, that could hurt bonds and stocks simultaneously. And that's, as our bread and butter is to make sure we're having diversified portfolios. And that's, making sure that we have things that are not moving all in the same direction. And that's, with bond prices so expensive, just being a little bit leery towards that.
Okay, thank you.
Thanks. Great question.
Nate, hi, this is Doug.
Hey, Doug.
Hey, correct me if I'm wrong, but I think I heard you say that you might consider sort of undershooting the equity targets for clients. And let's say I was a client with 65% equity and 35% fixed income target. Should I expect to see a decreasing percentage in equity and increasing percentage in fixed income?
Well, that could be one approach, but honestly, what I was worried about with the benchmarks as well, trying to keep up. And I actually, over the long run, it does better. but within a given year, if we're within the U.S. stocks, underweighting technology, the Amazons and Facebooks, if they're really technology, but these 5 or 6 stocks that are driving the entire stock market that make up over a quarter of the S&P 500. If our portfolio, at least for the U.S. stocks, looks a little bit more on the conservative side, if you will, or a little bit underweighted in those, and the NASDAQ or the technology stocks go up by 50% in a year, we're probably going to underperform it for that year. Over the long run, I feel really good about that kind of approach to avoid the higher price sectors. But I mean, look at things over the past couple of months. What has gone up the most has just continued to go up the most. So that could create a deviation in a shorter time from a benchmark. But honestly, my thinking would be that it's sometimes wanting to deviate from a benchmark can make a little bit of sense if that benchmark itself is riskier than it normally would be. And this is, this is truly, I hate to keep calling everything unprecedented all the time, but honestly, it really is, where the stock market is so concentrated in, depending on how it's looked at day by day, between 5 and 7 companies, to where it carries so much of the S&P. That's honestly never happened. So I don't know what's going to happen tomorrow, but I know honestly, it can't keep happening every day.
Thank you, Nate.
Sure, thanks, Doug.
Nate, it's Linda Burgeon.
Hi, Linda.
Hi, how are you?
Great.
I have a question, a general question. There's a big article today about the budget deficit and the level that it's reached, which is, again, unprecedented, in part because of COVID, but also, I'm sure, because of other issues. Do you want to speak to that at all? Does that impact us in terms of investment?
I don't know.
Sorry about that.
No, it's okay. But I mean, you're totally right. It can't even be overstated. I guess I don't think anyone even has a long-term plan in dealing with, and they did it 9 months ago either. But certainly with when the virus emerged, it was, well, just throw everything at it, no matter what, because, which there is a justification to that kind of thinking, because, when I try to arrest the slide and what's going on. But there's been, as far as I've seen, not one shred of an iota of any kind of clue about how we get back to some sort of stability where we won't just be buried in debt. And it's sort of interesting because you look around the world, there are other examples in countries or continents that have become buried in debt. They find they can't get out of it. So Japan has been buried in debt for 25 years and they can't get out of it. And we're not at that level yet, but between the commitments to the social spending, the military spending, and the way we've decimated the tax base, I have to say it's not very encouraging. I guess the positive aspect to it, and as I mentioned this, is, the governments are being allowed to borrow for nothing. People are giving them money and saying, you don't have to pay us back. Virtually 0% interest, or in the case of Germany or Japan, you get back less than you gave them. So I don't think anyone really knows where that leads to, as long as the citizenry or the investing world continues to be willing to lend money to governments and not get anything back or get back what they gave them. The system will continue functioning when they eventually say, wait a minute, which unfortunately that's what ends up happening, but I don't know when that'll be. No one knows when that'll be. So Europe kind of ran into the wall of that 10 years ago, 9 years ago, where some of the perceived as spendthrift governments, whether it's Greece or Spain or Italy, the lenders basically just said no. And the crisis that spawned was, really required Germany and the international community to come to the rescue. But if it's something like for the US or Germany or Japan, there is no one that can come to the rescue. So it's, there's no way to sugarcoat it. It's pretty scary. The last time we kind of had debt that was approaching this level was in 1946. But, very different world then, because the US was just the only power still on its feet, really, and could kind of control how the debt could be repaid, and our, companies and tax base were very strong. So it's, we can't really draw the comparisons with then and say it would be as easy to come out of it.
Is there any potential for restructuring the tax code that was first put forth by the Republicans, which obviously has impacted our deficit? If a new administration came in and they tried to get a handle on that, would that impact the deficit?
Yeah, I mean, if we went back to, to a little bit more redistributive tax code, that would certainly bring in some revenues. If you think about what had to be done in the late 40s and 50s, the tax rates were astronomically high. Things we can't even really imagine now, since they've been cut so much in the last 40 years. But they were unimaginably high in the world of 2020. And that was what was ended up needed to kind of restore the fiscal balance. I guess honestly, I'm not sure what the Republican plans are in terms of taxation. the Democrats do have quite a few taxes that would be coming down the pike in all different varieties. I guess maybe the concerning element of that, if we're talking about the deficit, is that they're planning on spending even more than they're taking in. So honestly, on either side, I have to be honest, there's not really very much encouraging if this is the issue you're very concerned about, because there's nothing coming out of either side that would give comfort on that regard.
Thank you.
Or thanks, Linda.
Hello, Nate. This is Yurata Landwehr.
Hello.
Hey, so I've got a completely left field sort of question. And I appreciate, I mean, I share your depression about the overconfidence of the stock market. It seems crazy to me. But what about that old favorite fallback, gold and metal resources? Certainly those are things that people fall back on in times when value seems suspicious. Is there anything in the mineral or metal or gold stocks that look useful to consider?
Yeah, I have to admit, yeah, in this sort of world, yeah, I guess you do have to look at it a little bit more seriously than we would have, earlier. We do know historically gold has been the world's worst investment because it's always done worse than everything else, just because it doesn't create anything on its own. There are the miners, which I heard you referring to. They've done better than the metal itself. But with them, you do get the stock market risk as well. But I would say certainly the way the world is developing, that it does make sense to look at, tangible assets. And honestly, with our clients, although it doesn't show up in a Schwab statement or anything like that, but many people, of course, own their homes, they own land, and that's an extremely effective hedge against, some of the kind of the things that we've been talking about.
Yeah, but so just for a joke, gold nuggets, right? Just joking. Thank you.
Sure, thanks. We'll keep our eye on it.
Nathan, I have a question. I was just wondering, although the stock market certainly has done unbelievably well considering what else is going on, some of that has to do with, it seems to me, that Amazon, other technologies have really flourished as people have to use more technology, are more dependent on technologies. We're stuck in our houses. We use it for shopping and communication and everything else, and now the kids need it for school, their computers. And the fact that there was a stimulus package that at least enabled people to purchase items on Amazon and use the technology businesses to keep them going and flourishing. What happens if there's no more stimulus going into the economy and there's an increasing amount of unemployment and et cetera, and businesses going out of, failing?
Yeah. Well, I will try not to appear overly cynical.
I'm not cynical. I'm just.
No, I'm going to try. I'm going to try. So there's definitely a huge dichotomy between the stock market and the real economy, if you will. And really what's happening in kind of the real economy is besides the technology, a lot of the, products, just things like home goods, things like that, they're doing fine because it's not only just from stimulus or things like that, because, there's a lot of wealth in this country. It's really the people that have more means that really do the spending. They support the overall economy. And the areas that are of the economy that are really suffering are the smaller businesses and especially the service type businesses like food, like cosmetology, travel,
Hotels,
things
though.
like that.
Tourism also.
Yeah. Um, Important, yes, and certainly from the real economy point of view, yes. But those are not the companies that are important in the stock market.
Okay.
So that's, but definitely you're right about the technology too, that this whole crisis has spurred more of a usage of people watching Netflix more, of course, that sort of thing. I guess my concern of what I was raising is, okay, so the profits have gone up, certainly a respectable amount. Things look pretty good going forward, but a respectable amount is not a huge amount. It doesn't mean that there's no upper limit to how much they can eventually be worth. And that's kind of where some of these companies are being valued as if there's no upper limit, infinity, infinity and beyond. So that's just kind of the concern about the companies. They've been in a great position. They're doing pretty well, although Amazon's profits, kind of lackluster, to be honest. But thinking about the future, yeah, I mean they're in a great position. But what is the correct valuation? Somewhere between infinity and reality. It's maybe a little closer to the infinity side right now, which is just a little bit worrying from the investor point of view.
Any
Anything else?
other questions?
Okay, so fabulous. So we will perform the MO that we've done with the other calls. We will eventually, have this recorded, put up on the website. We will send the link to you and our other clients, and feel free to listen again at your leisure. But no, we really thank you for your time and for the great questions that you've asked, and we just really appreciate you and the chance to work together. It just means everything to us. So thanks, and everybody stay.
Thank you.
Nate, sorry, it looks like you've got one question popping in here.
Oh, sorry about that.
Nate, can I ask one more question?
Sure, Linda.
So my question is, the stock market's doing great, and so our investments are doing great. But a lot of the economy is crumbling around us, which I think is the question that Rona was asking, okay?
Yeah.
The small restaurants, the clothing stores, even the airlines are having lots of trouble, okay?
Oh, yeah.
And they're going to continue to have it, and tourism. And people are in the tourism business. So we're watching that crumble around us, and yet our investments are doing great. But but part of the structure is crumbling. And how does it come back? Will it ever come back? Even the restaurants that are doing okay because people are eating outside, nobody's willing to go eating inside. And as the weather gets colder, will that change? Will they be comfortable eating inside, or will everybody say, oh no, and they'll still do curbside? I mean, somehow it almost seems unreal, like we're living on a bubble because this market is doing great, but it's like the French Revolution. The rest of the world is crumbling around you.
Yeah. Well, one thing I just think about this is cause is, admittedly, the economy is not at the level it was, so maybe we're just 85% or something of what it was. But a lot of what's kind of happening is really just sort of a shift, right, from the way we did things before to other things. So, think about, let's say this situation continues as you were kind of alluding to for a year or two or more. Who knows? You think about, okay, well, people don't have the same need for office spaces, things like that. People drive less, do this less. Well, okay, so they don't spend money on that, but they do spend it on their homes. They, realize they're going to be having this home office. It needs to meet their needs. They spend the money at Home Depot and Lowe's. People maybe don't travel overseas, they travel domestically. I don't know. They, all these kind of shifts in activities. Admittedly, it's going to be tough for the smaller businesses that don't have access to all the goodies from the Federal Reserve. But maybe, and I honestly hope this doesn't happen, but it could, and it doesn't mean anything from the stock market point of view, really, is that some of the, things will just be more concentrated. There'll be more chain restaurants and less individual ones because they have the financial muscle to ride this out, or to put all the money into creating the atmosphere that people can feel safe in. So it was just a restaurant across the street from us that closed after, 9 months of trying to hang in there. I guess 7 months of trying to hang in there, because they just don't have the outdoor space. They couldn't spend all the money to, create a safe environment indoors. And maybe, God forbid, sorry, nothing against Applebee's, but maybe it'll be something like that ends up, taking it over. And that's, unfortunately, it's actually been happening in many sectors of the economy throughout recent years, where smaller companies have just found it too difficult to, not just regarding the health, but just in general, to cope with the larger companies that have access to the financial markets and the incredibly low interest rates that can be taken. Whereas for a small business, well, these 0% interest rates aren't for you. It's, see what the bank will give you, if they'll give you anything. So maybe just some more of that consolidating where the big get bigger. Again, it's kind of this weird dichotomy between the stock market and the real market, the real economy. Because from a stock market perspective, if you own these, the larger companies that are able to consolidate and swoop up all these smaller ones for a song, it's good. It's really what you love to be able to do, is to swoop into companies in distress and that can't meet their payments and to buy them on the cheap. Is it the best thing for society in the long run? I'm not sure, but from the point of view of this discussion, from the stock market, it's honestly not that bad. And then the employees, will have to cope with it within that industry, or find other areas that are more adapted to the world we live in 2020. Happy thoughts, yeah, I know. Yeah.
Any other last questions? If you need to wave your hand up too. That's an option also. Okie doke. All right, Nate.
All right, so my times two. So anyway, sorry about that, Linda. I didn't see you that you had a question. But anyway, we will put this up on the website. Again, send the link to everyone. And again, just our gratitude for tonight and for all of our time together. And we look forward to, less interesting times ahead. Anyway, thank you. And I hope everybody has a great night and stay safe. Thanks.
Thank you.
Thank you, Nate.
Thank you.
Thanks.
Be well.